Hello and welcome to this latest edition of Courses on Demand brought to you by Forex.Academy. So in this course, we will be discussing order types and the variety of different order types that exist. Now, this is a topic that can often cause a little bit of confusion by the nature of the terminology behind some of these orders, but that's what we'll look to clarify over the course of this webinar. So just before we begin, if we can start, as we always do, with our risk warning and disclaimer. So please do familiarize yourself with the disclaimer. If you do need to pause this recording, do feel free to do so. Okay, so let me just start by explaining what you can expect over the course of this webinar. First of all, we shall do a very brief introduction to order types and the different types of order types which exist, and then we'll look at each one in significant detail. So we'll look at market execution orders, stop loss orders, take profit orders, and then we'll go into pending orders. So these are the ones that often cause certain amounts of confusion, let's say, with the terminology behind the names of some of these orders. But we do have two different main categories, and the first one is stop orders, which are there's two different types of pending orders, which are called stop orders, and there's also limit orders as well. So we're going to break those down for you in some detail. So hopefully by the end of this webinar, you'll have a clear and concise understanding about the different types of certainly pending orders, which can be used when trading these markets. Then we'll just summarize. There's just a very brief slide to summarize and highlight effectively the differences between stop and limit orders. And then we'll finish with just a practical application. We'll place those different types of orders into the markets so you can see how it all kind of fits together. Okay, so let's start with a brief introduction to market orders. So traders can navigate the financial markets with the use of technical market orders. And it's these orders that can enable you to get into a trade with a buy or a sell order, for example, but they can also protect your capital by drawing a line in the sand. So if the market does not behave as you would expect the market to behave, then we can use a market order to get you out of that trade. Also, a market order can be used, a different type of market order can be used to help you realize a profit on any particular trade as well. And finally, many traders do not necessarily want to get in to the markets at any particular point in time, or even perhaps the current price, depending on what's going on with price action. So a number of market orders can be used to get you into the market at a more opportune time of price. So for this, and to just give you a generic overview, to break down the different types of market orders, we have stop loss orders, and this is protecting your capital. So that is effectively drawing a line in the sand. We also have take profit orders, which is effectively looking to book in profit. We also have execution orders, which will allow you to buy and sell a market instantly. And as an overview, there's a number of different pending orders. And what these allow you to do is to either buy a market or sell a market at a particular price in the future. So obviously not at current prices, which would differentiate between a market execution and a pending order. Okay, so that's just a very, very brief introduction. So focusing on market execution orders. So these are orders that trade right now at the best available current price. So we can see currently up on screen, if we were looking to buy what happens to be the Aussie dollar, we'd be looking to buy it at a price of 0.7478. And we largely look to the fourth decimal place when we're trading currency. The same also applies if we're looking to sell the market. We'd actually be selling this market at a 0.7477. And the idea behind the market execution is that we'd have to use that kind of order to get into that market straight away. So if we click the sell by market red button, we'd be selling it at 74.77, and you would execute that order literally straight away at the best available price. So So this is effectively you trading on the market's terms. So you're accepting whatever's happening in that particular market. You are accepting that trade at that particular price that the market is currently offering you. So to sum up, this is effectively you trading on the market's terms. So you're currently seeing that quoted price and you're executing a trade off the back of the price that you are being offered. So this order, this type of market order requires you to be at your terminal to catch the trade physically, which is not always possible for everyone. So it's very easy to get distracted if you happen to be at your trading screen, or you might be called away with work or with family commitments or studying or whatever the case may be. It's very difficult to be there at the correct time. So obviously all of these orders have their limitations, and certainly a market execution order, the prerequisite for a market execution is that you have to execute the trade yourself. So you have to be physically there looking at your screen and be able to execute that market execution order in real time. You can always experience slippage as well with these orders depending on market volatility. So on occasion, even though depends, it can vary drastically from brokerage to brokerage, but the speeds now are pretty impressive. There's always, especially if you trade the major currency markets, you will always experience a relatively quick execution in that trade. The reason why we want to make a point of the best available current price is that, let's say, for example, we were selling this market at 74.77, and we click the button and there is a pause or a delay. And when we actually see our P&L or our terminal, we can see that the actual price that we got filled at was 74.75. So clearly there is a 2 pip difference between by the time we saw the quoted price, by the time we clicked the button and we were filled at the best available price. The best available price may be a pip or 2 away from the actual current price when you use that market execution. So, and that's just a form of slippage. That's the market moving at the time of you clicking that button and you getting filled at the best available current price that brokerage will offer. Now, the realities of this, they obviously can happen, especially if you decide to get into a market or you use a market execution order during a busy time, let's say, where there's perhaps a news release or the markets are particularly volatile. Then you can experience things like slippage, and it's a lot easier to identify as well. So please do bear in mind. So when we talk about market execution orders, what we're talking about is instant access to the markets. Okay, so in addition to market execution orders, what we also have and we can place in the market, and it's good practice that we do so, is a stop loss order. So these are orders that enable you to limit your potential loss if the market you are trading moves against you. So it's a phrase we keep using, but you are literally drawing that line in the sand if the market does not perform as you expect. So it's literally saying, right, I'm going to sell this market at 74.77. If the market pulls back to 74.97, a 20 pip stop loss, then under those circumstances, I would prefer to be out of this particular trade. Or as the example currently up on screen, if we were buying this market, just to turn it around from the other perspective, if we were buying this market at 74.78 and we placed a stop loss at 74.45 or 0.7445, you can see that there is a 33 pip stop loss in this market, and it's incredibly good practice for you to draw that line in the sand. So if the market is moving to the upside and we get into this trade, we perhaps use a market execution order. But if the market decided to turn to the downside, the 74.45 is our line in the sand that we draw, that we do not want to expose any more of our capital than that particular price. So consistently profitable traders prepare for failure by looking to make sure that they cap their losses. Losses are inevitable. There's no need to be frightened of losses. It is part and parcel of trading these markets. So in actual fact, they can be embraced to a certain degree. And the effective use of stop loss orders is a very, very important risk management tool that needs to be applied to your trading strategy. So when losses do occur, however, it is important to be able to know how much of your capital is actually exposed. So stop losses can allow you to calculate this. So let's say you have 3 trades with 100 pips stop loss in each trade. You can clearly identify that your exposure in those 3 trades is 300 pips, and that's a very straightforward. So you can know and you can understand and you can apply it to your trading capital, what that is likely to entail if all those 3 trades moved against you. So it does have some, they do have some really structurally important roles to play in a consistently profitable trader's strategy and approach and risk management approach. This order can be used to book in profit as well, don't forget. So let's say we happen to be buying this market at 74.78 and the stop loss is 74.45. So there was a 33 pip stop loss in this market. However, the market starts moving up to 7,500 and then 75.50 and 75.80. And let's say the market gets up to 7,600, let's say. So we'd actually realize 122 pips profit. So what we could do is we could actually utilize the stop loss. So we could actually put in 75.80, for example, and say, right, well, I would like to book in 102 pips of that profit. We can actually use that stop loss. So if the market is trading around 7,600 and it pulls back a little bit, 20 pips to 75.80, then actually our stop loss can be triggered. Now it's easier if you refer it to as a profitable exit, but it is still technically your stop loss that you are using to book in profit. So do remember that as well. It does draw a line in the sand and it does limit your losses from a negative perspective, but from a positive perspective, it can also be used as the market is moving in your favor. You can bring up that stop loss price and you can capitalize and capture some of that profit that you've been able to attain. So that is a stop loss order and how it's implemented. What we also have, and you can see just to the right of the stop loss order, is a take profit order, and that's what we're going to discuss now. So these are also known as guaranteed orders that enable you to book in profit at a certain price, or as some more hesitant traders, let's say, or there's perhaps a little bit of negativity towards using take profit orders in certain situations. So as some traders see take profit orders as orders which limit your potential profits if the markets move in your favor. Now, from a personal perspective, any profitable trade is a great trade. So whether you use your stop loss, whether you close that trade manually, or whether you use a take profit order, what you're doing is you're booking in profit, and that's always to be encouraged. And actually, the better you become at that, the more successful you'll be at trading these markets. So in this example, we can see it's the same as the Aussie dollar. We're looking to buy this market at the price of 74.91. We've made sure we've mitigated our risk to the downside of 74.45. So in this particular trade example, it's a 46 pip stop loss in this example. But as you can see, we can also place a take profit. So if we look to buy this market at 74.91, we can actually predetermine a level. So that's where you can do your technical analysis. You can plot the levels on your chart and you can decide if the market moves to the upside, we can look to take profit at a particular level. And we can use a take profit order to allow us to do that. So what we're saying is we can absolutely limit our losses to the downside, make sure we take a 46 pip loss in this market, but we can actually identify a multiple of that in terms of taking profit. And this would represent a positive risk reward as well when we trade these markets. So it would mean effectively 159 pips winner to the upside in exchange for a 46 pip winner to the downside. So we're talking about a 2-to-1 positive risk reward in a trade like this. But we are using take profits to actually execute that particular order. Now, it is important to only mentally book in profit when the order has been executed and the capital has been realized. The reason why we say that is many traders, if the market is moving in their favor, they can almost anticipate that the money's almost banked before it actually has been banked. So even if you do have these take profit orders sitting in these markets, it's very important that you as a trader realize that their orders and that the market actually has to conform to that particular price, as opposed to a market that could get 5 pips away and roll over to the downside, and you could leave a lot of that profit on the table. So you still have to manage these orders very effectively. It's a risky strategy to just apply it and forget about it, because you could get that market getting within a few pips of that level and only to see it potentially pull back on you, which is again, from a psychological perspective, is a very difficult thing to come to terms with. So always try to get into that routine of monitoring these trades, using these take profit orders and other orders as well to assist you with navigating these markets. Okay, so that's take profit orders. So in addition to market execution, in addition to stop loss, and in addition to take profit orders, we also have a series of pending orders. So to just give you a brief introduction, these are orders so you can trade at a price that is either above or below the current price. So where you can wait for the market to come to you. So not everyone is going to be able to take that trade at the time in which they're looking at these markets. So pending orders are very useful tools that can be used by traders. And it's important to note, these are orders that are useful to different traders for very different reasons. So it actually depends on your approach and your style in terms of which potentially pending orders you decide to use, if any at all. So a lot of traders trade market conditions, meaning that they'll trade intraday timeframes. They'll look to get in and out in the course of a trading day, which is absolutely fine. But what they'll find is they'll have to commit considerable hours in front of a trading screen to be able to, first of all, be there when the opportunity presents itself, execute those trades, then manage that trade and exit that trade somehow. So sometimes that can be quite time consuming. Whereas pending orders, they operate in a slightly different manner. They can also allow you to trade without experiencing significant slippage. So when you place these levels ordinarily, now you can be exposed to slippage, but more often than not, when you work with pending orders, the levels that you use to enter and exit, the levels that you use to enter these markets are normally pretty accurate. And one of the major reasons for that is you can often have price, moving in these markets during quieter times potentially. So they can be used to really good impact depending on your style and approach to trading these markets. So these orders can allow a trader to trade on their terms and avoid chasing markets. Knowing which markets you want to trade and which direction you want to trade them is a very important skill to develop. And if you know that information, you might be able to utilize your trading skill to identify particular areas that you would like to either be buying a market at a certain area or selling a market at a certain area, and pending orders can be used to facilitate that. Now, I suppose the biggest thing why traders use pending orders is that they absolutely allow for greater objectivity when they trade. And again, trying to remain objective is actually a really important skill as well. The last thing you want to be is too subjective, too opinionated about what you think a market will and will not do, based on information that may or may not be correct. So anything that can assist you with objectivity, give you a bit of perspective in the decisions that you're taking, will obviously be a good thing. And identifying areas for those technical traders out there, to identify areas in a chart where you'd like to be buying from or you'd like to be selling from, then that is really why people use these pending orders. Okay, so let's go through these different types of pending orders. So we have a number of pending orders which are referred to as stop orders. So not to be confused with stop loss orders. This is where some of the confusion may enter. So these are market orders that can be used to enter a trade at a particular price. So these orders can be used to buy a market above the current price, or you can also sell a particular market, but this time below the current price. So whatever the current price happens to be right now, we can use stop orders to actually buy the market or sell the market at slightly different prices to the current price. Except if we're buying, we can use a stop order to buy that market above the current price. And if we're selling, we can use a sell stop order to sell the market below the current price. So you can still suffer from slippage, but you are less likely to experience significant slippage. And often the reasons for that is the potential of volatility around those times and prices. However, it is still, of course, very, very possible. These orders are best used for breakout trades. So the reasons why we say this, it's just looking at the chart currently up on screen. And if I just grab my pen real quickly, you can see the current price there is actually at the 1.2000 level. And what we're saying is we don't know whether price is moving to the upside or to the downside, but someone that wants to use a buy stop order might decide to identify this dotted green line as a fantastic opportunity to look to buy this price. And if price gets up to that level, then we'll be in this market looking to push prices to the upside. So that is a buy stop order. So what I might do is just place this in here for you. So this is a buy stop order at that green line. And what we can also do is we can identify the red line this time, and if we do our analysis and we think if the price moves down to this particular level down here now, we can really plan ahead, and we can say if the price gets down to that level, we can look to get into this market and look to push prices lower on this occasion. And this is a sell stop order. So these are two stop orders. One's a buy stop order, wanting prices to push higher, and one is a sell stop order, looking for prices to push lower. So that's how that's why these types of orders can be best used for breakout trades, because we could identify the green line as a breakout trade to the upside, and we can also identify the red line as a breakout trade to the downside. So hopefully that makes some sense. And these are orders that can be used, and they're called stop orders. Buy and sell stop orders. Okay, so that's just a very brief visual there for you. So moving on then to limit orders. Again, not to be confused with a take profit, which is also referred to as a limit order. And again, this is where some of the confusions can start to kick in, where a trader can be talking about a pending order, but actually looking to apply a limit order or a take profit. So, so do be careful of your terminology. So when we look at limit orders, these are market orders that can be used to enter a trade again at a particular price. These orders can be used this time to buy the market, but this time below the current price, or we can look to sell a market, however, this time above the current price, whereas it was the opposite way around with the stop orders. You can still suffer from slippage, but you are less likely to experience slippage in this situation. These orders are best used this time for pullback traders. So we actually have exactly the same chart currently up on screen. However, we're using different orders for different reasons on this occasion. So what we're going to do is a trader this time would actually be looking for the market to actually pull back to the red line to use a buy limit order, but this time at the red line, looking for an opportunity to take this price from the lower price and look to drive these prices higher. So we're looking to buy the market this time below the current price. So the current price is at 1.2000, but we're actually looking to buy the market back at the 1.1994 level. So again, it's below the current price, but we're looking to buy the market on this particular occasion. Now, the same is true for someone that's wanting to use a sell limit order. So this is when we want the prices to actually squeeze higher. And if it does, we would like to be triggered around this green dotted line. But on this occasion, we'd be looking to sell the market, and we'd be looking to trade a sell limit order. So at this point, we're actually looking to sell this market to the downside. So we are looking to sell the market at a price which is above the current price. So that's the important differences. And this is why it's a pullback trade. So we're getting a pullback in prices, and then we get the explosive move that we're looking for. So that's why these two different types of trades, whether it's a buy limit order wanting to pull back to the red line to push higher, or a sell limit order where you want prices to pull back to the green line and look to take that trade to the downside. And I appreciate this can come across a little bit on the confusing side once you're first exposed to these types of limit orders. So to make it a little bit easier, let's do a summary on one page where you can hopefully get a little bit of an understanding of stop and limit orders. So let's begin with a buy limit order. So this is when you wish to buy below the current market price. What you'd be using, if that's what you're looking to do, you're wanting to buy the market below the current price, then you would need to use a buy limit order. If you wish to buy above the current market price on this occasion, then you would need to use a buy stop order on this occasion. So again, your buy limit orders are for your pullback trades, and your buy stop orders are very much for your breakout trades. When you identify a level above the current price, you'd be looking to capitalize on that particular breakout move. Now, to the downside, if you wish to sell below the current market price, you would be this time using a sell stop order. And if you wish to sell above the current price, then you would be looking to use a sell limit order. So this may come across a little bit confusing to begin with. I do promise you it gets a little bit easier to understand. Now, probably the best way to do that is to show you practically how to apply each one of these pending orders. So this is a really nice summary. You might want to take note of this, and that is effectively how you can utilize the different types of orders to buy markets at different prices to the current price, whether it's above the price, below the price. You can use a variety of different orders pending orders to enable you to actually execute trades at those prices. Okay, so that's a little summary of stop and limit orders. So let's do a little practical application of the various different order types. So let's review the different types of market orders and how to execute them on a MetaTrader 4 platform. So for this, I'm going to bring up our platform here. And this just happens to be a Aussie dollar. It doesn't particularly matter. But we do have our terminal just at the bottom of the screen. So the first thing I'm going to do is take a market execution order, and I'm going to actually place, let's just say we've done our analysis and we expect this price to push to the upside. So what I'm going to be doing is looking at the price here on the right hand side, just above the buy by market button, and it's 0.7490. So when we place a pending order or a market execution order, and that's what effectively we're going to be placing now, but we're also going to make sure that we put in our stop loss order on this trade. So I'm going to suggest that we want to take this market to the upside, but if we get a break, let's say a 10 pip stop loss to the downside, that's my line in the sand where I'm not prepared to take a loss below the 74.81 level to the downside. So as things currently stand, it represents a 9 pip stop loss in this market. But what I'm also going to do is I'm also going to place a take profit, which suggests that just like drawing a line in the sand for a loss, we now want to use this type of take profit order to draw a line in the sand. So if the market pushes higher, then we want to book in at the profit around the approximately around 10 pips above the current price, 74.91. So the 75.01 level would be 10 pips above the current price. So what we're actually doing with this one, we're actually placing 3 different orders. We're placing a market execution order with a stop loss order and a take profit order as well. So let's go ahead and proceed with that particular buy. And what you'll see straight away in your terminal is the type of order that we've placed, and we've decided to go ahead and buy this order. Obviously, get your size correct. Make sure that you calculate your size appropriate to your account size and balance. The market we're looking to trade is the Aussie dollar. The price we're getting in at, and that we've actually been filled at, is 74.91. So that's the best available price that we can get into this market. And the stop loss that we've placed is 74.81, and the take profit is the 75.01. So we do have a visual look on screen as things currently stand. So you can see the green line is our entry price, the lower red line is our stop loss, and the upper red line is our take profit. So as things stand, the market is continuing to squeeze lower. That doesn't matter so much. What we've done is we've executed a market execution order with a stop loss and a take profit. And this is effectively how you go about doing that process. So what I'm going to do is I'm going to cancel that. So that's really the how to utilize market execution orders. So what I'm going to do is I'm going to cancel this particular trade, and then we're going to move on to pending orders. So there's 2 different types, and for that, what I'm going to do is I'm going to get up our pending order. So let's do a little bit of technical analysis on this trade. Okay, let's monitor this low down here. So I'm going to put a level in at 74.72, and I'm also going to put a level in just above this recent high, the 74.98. So what I'm going to do and how I'm going to utilize those particular that technical analysis is I'm going to place what's called a pending order. So this is when I don't want to get in at these current prices, the 74.87. I don't feel comfortable getting in. But what I would like to do is to place a buy order at this lower level. So there is a means and a way for me to do this. And effectively, it is a buy limit order. So when we click on pending orders, we have a drop down. We can do market execution, which is what I've just placed, or a pending order. And we can click order type, and you get the 4 types that we can choose from. So we're going to place a buy limit order, which means we don't want to buy at the current price. We'd rather buy below the current price, but we want to be buying this market to the upside. We think we think we'll see a double bottom around the 74, 72, and we're looking to trade this actually to the upside to the 7,500 plus. So we can use a buy limit order, and we just need to place in the correct price. So 74, 75, let's say. So we'll do it just above that current level there at the bottom of your screen. Again, we can place a stop loss, so we will utilize that opportunity every single time. So if we look to get in at 74, 75, we'll put a 10 pip stop loss in this market, and we'll also look to capitalize on some profit at the 7,500 level. So you want to just double check, make sure you're trading at the correct volume, you've placed the pending order, and you've got the correct price to buy this market at these lower levels, and click place that trade. So now what we're seeing, and if I zoom out, you'll also see my stop loss. So we effectively do have a stop loss sitting at that level. It's just not always easy and that straightforward to see it. So if I just zoom in on a smaller time frame again for you, we can see, looking at this price action, that actually it's a green line. So we do want to, it's a buy limit order. So we do want to buy this market. So we're waiting for the market to come to the downside before we can take this market to the upside. And because we're looking to buy this market at this level, we do have a 10 pip stop loss just placed beneath this level here. So it is a buy limit order. We're looking to buy this market below the current price of 74.88. Now, what I'm going to have to do is, because I don't want the lines on screen to confuse you in any way, so I'm actually going to delete that particular order because we've been through that process now. That's a buy limit, and it's to just show you how to place a sell limit order this time. So we go down to the pending order, and we make sure we place this time a sell limit. So on this occasion, it's just literally the other way around. We actually want to be selling this market from this purple line up here at 74.80.98. So actually, we're just going to place our pending order just below that level so we can see it. 74.96 can be our entry price. Stop loss, if we sell at 74.96, we can place a stop loss at 75.05 or 06, let's say. Just keep it 10 pips apart. And this time we want to get into this market just below the 74.96, but we actually want to capitalize on some profit at these lows. So we're going to say 74.75 can be our take profit. 74.75. So not as much profit. We're not looking for as much profit on this trade. And once you've checked your trade, just go ahead and place that trade up on screen. And this time we've placed a sell limit order. So we want the market to bounce back to this level. If so, we'll have our stop loss placed at the 75.06 level. And we want this market to bounce off this level and roll to the downside. And we are able to book in a nice 2-to-1 profit on that particular trade. So that is just a practical explanation of our buy limit orders and our sell limit orders, and that's effectively how they work. Now we also have buy and stop orders. So for that, I'm going to just remove another pending order. Again, it's just to avoid confusion. So what we're going to go ahead and do now is place what's called let's place a sell stop order. So we can still work with these two levels, the 74.98 to the upside and the 74.72 to the downside. But we want to capitalize on a breakout of the 74.72. So we want to sell this market below the current price. So this is quite straightforward. Again, we do our analysis and we identify a level which is just marginally below that level. So we just do 1 pip below that level. And let's just say, for argument's sake, we do want to place a stop loss above the high. So again, we can go over to our stop loss order, place 75.02, for example. So we're effectively a 31 pip stop loss on this trade. And let's say we want to manage it to the downside. So we think there's a nice explosive move to the downside. So we're going to manage it carefully. We might place a take profit at a later date. So we go ahead and place that take profit here. So what you see is a sell stop order, wanting to capitalize on this market breaking through that level. That's why it's referred to as a breakout trade, because generally when you get breakouts of support and resistance, or when you physically see the price breaking through those levels, then they're referred to as breakout trades, and you can use these types of orders to capitalize on those big moves. So we have our sell stop order to the downside just below the 74.72, and we have our stop loss just above the 7,500 there sitting in this market. So that's how traders utilize these particular different types of orders. And you can see here with this order, the Aussie dollar, it's a sell stop order. It's sitting in the market. It hasn't been executed yet. And we want to get in at 74.71 with a stop loss of 75.02. So just to conclude, the last practical execution of a buy stop order this time, we're just going to cancel the sell stop, and we're going to place a new order. And this is the last and final pending order that we're going to be placing. And it is this time a buy stop order. So what we can see is we're not comfortable buying at this price here, the 74.88. We would like to buy it above this level. So we'll place a buy stop order this time. Again, we want prices to break out above the 74.98. So we're going to place our price to get into this market just above that, 7,500, and let's place our stop loss beneath this range low, 74.71. So this is what we're doing in return, placing a buy stop order in the Aussie dollar. It's a pending order at the price of 74. Sorry, this should be the other way around. Sorry, let me just fix that. 7,500, and this should be the 74.71. So the entry price, and this is why it's really worth to just double check what you're doing, because when you place a pending order and it's a buy stop, it's the price that's underneath the pending order that needs to be correct. So you want to make sure, I mean, it just so happens the system wouldn't let me take that particular trade. But we can troubleshoot it now. It's because the price was incorrect. So we only want to buy this market above the 7,500. And if we do, we'll place our stop loss at the 74.71. And on this occasion, we would like to take profits at these higher prices up here. Let's say the 75.40 level, something like that. That's what we'd like to do. So you can see our entry order here. It's a buy stop order. We want to capitalize on the breakout to the upside. If we do, we have our stop loss at the 74.71. And you can see all these figures in your terminal as well. All those figures are there. And we're going to capture a nice sort of profitable trade up to the 75.40 level. So all these details are in there correctly. And that is a practical explanation of how to go about placing a market order and the 4 different types of pending orders, all with stop losses and take profit orders built into them. So we've had hopefully a comprehensive review of all the different types of order types that can be used when trading these markets. So as you can see, we've had a look at market execution orders, stop loss orders, take profit orders, and a series of pending orders as well. We have 2 stop orders, 2 limit orders, and we've had a bit of a summary of that. And then we've hopefully done our best to practically apply the implementation of these different types of orders. So all that's left for me to do now is to thank you very much for joining us. We do hope you've enjoyed this webinar. So from everyone here, do take care and bye for now.